What is going on, traders? Fresh off the heels of the largest rate hike since 1994, here is why things are going to get exponentially worse. Also, I'll be telling you the levels that I'm looking at on the major indexes, mainly the S&P 500 and the NASDAQ, and at what point I'm scheduling my next buy points on those major indexes. If you guys are part of the elite trading group, you know that most of our plays have been bearish as of late, and we continue to collect money on these drops. Meta, Nvidia, ExxonMobil had a 135% hit on Waste Management, 126% hit on EA. If the only thing you know how to do is buy stocks in this environment, you are going to feel max pain. So I suggest that you pick up some of these tools that allow you to play different directions in the market, especially during market environments like this. Also, you guys may know this from yesterday's live, but we closed signups to our Elite Trading Academy. We want to keep it a tight-knit group. You could still apply if you want to join. You will see that link in the description. So make sure you apply, talk to one of our ambassadors. We have thousands of traders talking about trades all day, every day. We have day trades going on. Obviously, the swing plays that I showed you earlier. We have the stock market analysis. And every month, we also do private Zoom calls with me where you can literally ask me about anything you want as it relates to options trading, day trading, how to set up strategies, how to evaluate companies, etc. It is a great value. So again, you have to apply. Link is in the description below. Apply if you want to be a part of the group. Anyway, let's get right into it. So as we covered on yesterday's live, the Fed has had the biggest rate hike since 1994. They raised by 75 basis points. They initially were going to raise by 50 basis points, but because of what's going on with the economy and with the market, they had no choice but to try and fight inflation more aggressively, especially since the CPI data last month came in higher than expected. Now, speaking of inflation, here is what is scary. If we take a look at how institutional investors are betting, this is the most alarming trading activity with regards to the CPI that we've had ever since COVID started. Right now, fixings traders, and I've gone over fixings very briefly on this channel. I'm not going to get into it in full detail, but fixings are basically a derivative that allow you to bet on the rate of inflation. And right now, fixings traders, which are mostly institutional, are betting that we see at least 4 straight months of roughly 9% year over year or higher CPI readings. This is very bad news, especially considering how aggressively the Fed is trying to act now, even though they're acting a bit too late, and the fact that they're doing it in an economic slowdown and during a major bear market. Usually when we do rate hikes, we're doing so into strength. So if this is the case that we see, even if we just see a month of 9% or higher, meaning that the CPI reading, so say the next CPI reading that comes out on July 13th is higher than last month, which was 8.6. If we see a 9%, then it's really going to signal to the market that the Fed has no idea what it's doing and whatever it's doing is not working. So on the S&P 500, as I've stated before, 3,500 was a very realistic target, and it looks like we are going to get there. We only need a couple percentage points really to get to that 3,500 mark, which is the 200 moving average on the weekly and the 0.5 fib level if we're measuring the trough at the COVID crash and the peak at around January 2022. However, if we do get a 9% reading on the next CPI data, I can easily see us fall through this like a hot knife through butter, and we will hit that 3,200 level that I talked about previously as well, which is at the 300 weekly moving average and the golden pocket between 3,100 and 3,200 on the S&P 500. That will also be near the pre-COVID highs on the S&P 500 and would take us down to 34%. As I mentioned before, the average bear market is between 30 and 35% on the S&P 500, so that would be in line with that. The next alarming thing that I'm looking at is the GDP. If we look at the most recent GDP model, which came out on June 15th, it shows that the model has slipped to zero growth. This went from 0.9% increase to zero growth, which means our margin of error is basically non-existent. So if we come just 0.01% below this, we will have a negative quarter of GDP, which would put us at 2 consecutive negative GDP quarters and officially throw us into a recession. You could see here Q1 2022, we had a negative GDP reading. Another one, even if it's by 0.01% negative, would put us into a second consecutive negative GDP reading and an official recession. The next GDP reading comes out on July 28th, so keep your ears and eyes peeled for that one. All right, the next thing that I want you to take a look at is the Dow Jones Home Construction Index. This is basically the home builders index. We are currently at a level that we saw in 2006. So we have lost basically all of the gains that we've made in the last few years. And we are now back at 2006 levels. Now, I'm personally torn on this. I don't think that we will see a housing market crash because I don't think that we have the same credit risk that we did back in 2008. However, I do think the housing market is going to slow down tremendously, especially as mortgage rates hit 6%. And on some sites like Rocket Mortgage, you're seeing 6.25%. So 6% and above, I mean, it's going to price a lot of people out of the market. Furthermore, and this is something I probably should have led with, is the bond market. Bonds and treasuries are seeing very alarming signs here. The bond market has been a much better predictor of a recession and a downturn than the stock market because it is a much bigger market and treasuries are used as a safe haven. So when there is a bond sell-off, that shows you the sentiment that even in safe havens, investors are wanting much higher rates or yields, which means that they continue to sell bonds and not buy them. And if we look at foreign treasuries, meaning foreign countries that hold U.S. treasuries, China being one of the largest, their holdings of U.S. treasuries are down to a 12-year low. This is as the 10-year yield has hit the highest mark since 2011. So clearly we are seeing a sell-off in the bond market, especially as the fears of inflation continue to rise and continue to actually be at a significant level, which means that, investors aren't confident that these bond yields are going to be enough to protect them against inflation. So, they continue to really take their foot off the gas as it relates to bond buying, and yields continue to go up as a result. And lastly, before I get into the levels that I'm looking at on the indices, I'm going to be monitoring the unemployment situation pretty closely now, more than I have before. During coming out of COVID, the unemployment rate to me was just a formality because we were at historic lows. However, I've shared this with you before. Before a recession, we tend to see employment at near recent lows. And then once unemployment starts to climb back up again, that's when we fall into recessions. And you can see these gray bars here. These are all the recessions that we've had in history and how unemployment was near a recent low before starting to tick back up again. And this is as tech companies are starting to lay off people. So if you look at the list of tech companies here that have had layoffs or freezes, I mean, some of them are expected, but some of them are actually pretty significant because they're mega cap companies. So obviously Coinbase, Redfin, Peloton, then you have PayPal, Tesla, Carvana, Meta, Intel, Microsoft, which is unexpected, Uber, and Lyft. So the next unemployment readings are coming out July 8th for the month of June, and I'll be very interested to see if we start ticking back up again. Right now, unemployment is sitting at 3.6%. If we start creeping up to that 4% range, I mean, that's when my antennas will start going off because it will signal that we are probably closer to a recession once we start seeing that unemployment rate start ticking back up after hitting near lows or recent lows. All right, so what levels am I looking at on the S&P 500 and on the NASDAQ? On the S&P 500, I mentioned this before, but I will start looking at buys here at around the 3,500 level. I will start dollar cost averaging again, probably at around 3,500 with some more heavier buys at around the 3,200 level, which again would put us down about 34-35% from highs. Also, I'll be monitoring the weekly RSI, not the daily RSI, to see if we can get into major oversold territory somewhere near the low 20s, because historically, coinciding with that major drop of 30% or more, that has always been a historically good buy point for the long term. So that is where I will start looking to pick up the S&P 500. Now, in terms of the NASDAQ has already been in minus 30% territory, and the NASDAQ is much more sensitive to rising rates and stuff like that. So, I do think that you can warrant some buys here on the NASDAQ at around the 10,800 level. And if we drop below 10,000 eventually on the NASDAQ, that is when I will start looking to aggressively buy anything in the 9,000s really. Again, this is for long term. If your horizon is much shorter than that, if you're going to retire in a year or two, or whatever, you have a lot more to think about. Anyway, traders, that is it for this video. Let me know what you think in the comment section below. How close are we to a recession? Are you doing any buys here. What are you buying if you are? What do you think of the prospects that we will be in a recession in 2022 versus 2023? I love hearing from all of you. I try to respond to every single comment, especially the well thought out one. So leave a comment down below. Hit that thumbs up if you get anything out of this video. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.